Welcome back to Demystify Sci. I'm Shiloh.
I'm Anastasia.
Today we are picking up our conversation with Bill Lazonick, who is the president of the Academic Industry Research Network and a former professor at UMass Economics Department. Bill's main point is that the financial structures have evolved, at least in this country, but more so on a global scale, to the point where they are more extractive than productive in terms of providing better products and better working conditions to the employees. One of the ways this happened, we talked about last time, is through stock buybacks, but more generally through shareholder value ideology, which has crept into the way that CEOs make decisions and boards make decisions about the future directions of their companies. Today, we are looking at some other aspects of shareholder value ideology, and in particular, the machinations that allow that process to unfold. We're exploring all sorts of new terms today, well, new to us anyways, such as private equity, corporate rating, hedge fund activists, junk bonds. Bill has an intimate knowledge of all the working pieces of the puzzle that amounts to a situation where companies are actually feeding the stock market instead of feeding their own production. And that doesn't seem like a very good plan for a stable future economy.
As always, if you like what we do on the show, consider coming over to patreon.com/demystifysci. For just a couple dollars a month, you can help us keep the show running, and you can also join our fantastic crew of Sunday Salon attendees, where we basically get together and we talk about the things we talk about on the podcast. We talk about things that we haven't talked about on the podcast yet and try to figure out how the world works in a group setting. It's been really cool. We have some people that have been coming from the very beginning. We've recently gotten some new folks to show up. You can come with video and microphone, or you can just hang out in the chat. It's a pretty cool hourly adventure on Sunday mornings. We are also incredibly excited about the fact that we have our second upcoming conference. It is called Demysticon 2025 Beyond the Big Bang. And what we're going to do is we're going to get together three groups of stakeholders: the theorists, the observationalists, and the commentators. And we're going to get them into a room on the seaside in, say, Coimbra, Portugal in June of 2025, this year. And we're going to figure out what actually lies beyond the Big Bang, what are the greatest arguments against it, what are the greatest arguments for it, and how can we move the field of cosmology forward. This is on the back of a very fun, very successful conference that we had in Austin, Texas for the eclipse last year. And it was such a good weekend that we decided to do it all again. We hope that you join us. Memberships for that are for sale here.
If your budget's not big enough to bring you out to Portugal, you could check out our new line of t-shirts down below. You could also just support the podcast by sharing it with somebody who you think would benefit from hearing these conversations. You can come over to Discord, Facebook, Instagram, Twitter, basically anywhere. Search Demystify Sci. We'll be there, and we would love to hear from you.
Leave a comment, like, subscribe, tell a friend about the podcast. All of these things help us. And in the meantime, enjoy our conversation with Professor Emeritus Bill Lazonick about the details of how shareholder value ideology has allowed corporate raiders to take over the world.
The scientific revolution starts now.
The Demystify Sci podcast.
Let us see in the dark.
The hedge fund's goal is to make as much money as possible, which means not just getting the share price up, but selling the shares at the right time. And they might hold the shares for several years. I'll give you an example of this. Well, here's an example of Carl Icahn. So let me backtrack. Let me use the case of Carl. People have heard of Carl Icahn, Icahn.
Mm-hmm.
He's a multi-billionaire. He's a guy, very smart guy, now in his 80s. Decided early in his career, somewhere in the 60s or so, that he wasn't going to be a doctor. He went to medical school, but he was going to go make money on financial markets. Okay. So, and that was in the 1970s. And if we put it in context, the 1970s, remember last time I talked about the conglomerate movement. And then it fell apart, that the notion a good manager can manage anything just did not work. And what happened in the early 1970s, I know you put on the YouTube on the last session, 1971, right around there, was many of the debt that had been used to finance the building of these conglomerates, the acquiring of other companies, became very risky and low grade because the companies weren't performing very well. So the price, the value that you could sell that bond for fell, and when the value falls, the yield goes up, and they became known as junk bonds. So if you issue a new junk bond and it's like 12%, that's a very risky bond, and people know that there's a risky company. But that really occurred not because in the 70s new bonds were being for companies were being issued, but the once good bonds of the conglomerates, where people thought that these companies would really be able to operate well this way and perform well this way. Now they weren't performing, so they had very high yield, very risky. This guy named Michael Milken, which I'm sure most listeners have probably heard about in some context. Rudy Giuliani threw him in jail. I think I mentioned that last time. In the late 80s, he came in the 1970s, working for a company called Drexel Burnham, and said, if I can get a lot of institutional shareholders, pension funds and mutual funds, to be willing to hold these junk bonds, I can create a market in the junk bonds so that as long as lots of people are holding them, then the market becomes liquid. And if they want to sell them, they can sell them, even though they're risky. But right now, they're just being held by whoever held them before, and they're very difficult to sell. And I can make money just creating this market in junk bonds. So that's what he did very successfully in the 1970s. At that point, in the late 1970s, within these conglomerates, there were companies, a lot of divisions, sometimes 100 or even 100, 200 different companies. And some of the managers of those divisions, who actually knew what was going on in the companies, wanted to take them out of the company. So they often were financed. KKR, which a company which later became very famous or infamous, grew up helping to provide money to these companies to buy them, for the managers to be a leveraged buyout from the companies, but it was really to have a separate operating company that now wasn't part of the conglomerate. So they had to pay a lot of money because it was very risky to do this. And the junk bond market meant that there was a market there where they could issue these high-risk bonds. So these high-risk bonds started being issued, new ones, to do this purpose. But then by about the mid-1980s, when shareholder value kicked in and it was called the deal decade, people said, oh, and Milken was very much involved in this. This is what he went to jail for, was that, and a guy named Ivan Boesky, you might have heard of him, who was a kind of arbitrageur, hedge fund guy at the time. They said, if we can line up enough institutional shareholders, or savings banks were also used, to commit to buy the bonds of these companies, we can take them over and then get control of them and break them up. And the companies will be very in debt, but they'll basically be buying their shares. We'll be buying their shares with the bonds. They'll now owe this, and we can break them up. And they did this with RJR Nabisco, which was a big deal around 1987, and that was part of one part of the financialization of the U.S. economy. Okay, at the same time, however, that was more using. It was a kind of a predecessor of private equity, but of using, getting companies, getting control of them, and then having that control be very concentrated, and then just making money selling them off in pieces. But at the same time, back to Carl Icahn, he was looking at the stock market, and the stock market in the 1970s was moribund. It just was not going anywhere. Okay. NASDAQ had been created as an over-the-counter market for kind of speculative companies, which became a lot of the tech companies in 1971. It was really a listing. It wasn't so much trading. It was still, the trading was still very fragmented. But the New York Stock Exchange was there. It was not really going anywhere. But Carl Icahn realized around the late 1970s that if he could buy shares in a company and be a bully and go in and write a letter to the executives and say, I own 2% of the shares of your company, or 3% of the shares of your company, or maybe if the company was not that high market capitalization, even more, 10%. And I want to have a say in how your company's operating. I want my people to be on the board. I want you to sell off these divisions, do this and that. It's going to create so-called shareholder value. And if you don't do that, I'm going to do it for you. and actually, this became known as greenmail, like blackmail, but green with the money. And he did it with a number of smaller companies, relatively small, but they'd often be Fortune 500 companies, but not the biggest ones. And often the top executives, buckled very quickly, or they saw it in their benefit to go along with them, to keep their job, to give them this money, and then to focus on getting the stock price up and benefiting themselves with what became back in fashion in the early 1980s, from the early 1980s, stock-based executive pay. So he was making money doing this, making $3 million here, $4 million there with a rate on companies. And as he did this, he built what he called his war chest. So he had more money to go in. He had a bigger kind of, he was more visible. People were more afraid of him, frankly. And he went in and he kept doing this. Now, around the mid-'80s, he went a little too far, because he went after the airline TWA, and he ended up owning so much stock in it that he had to actually take control of it, which is not what he wanted to do. Although while he took control of it, he managed to cut the pay of flight attendants dramatically, try to attack the pay of pilots. So there was actually part of it started off kind of, particularly among a lot of flight attendants, for example, much lower levels of pay than they had gotten before, even though they had unions, and he was coming in and attacking them. He had eventually sold. I think it went into bankruptcy under him, but then he moved on to bigger and better things. But he kept doing this over time. Now,
so I have a question here.
Yeah.
Here. So Icahn, you say he starts by owning a relatively small number of shares in a company, 2% or something.
Yeah.
And then he sends a letter to pressure the CEOs or the boards to do what he wants.
Yeah.
Is the leverage of that letter the fact that no one else owns so much of the stock? Because and he's basically like, if you don't do what I want, I'll dump the stock and tank its value, because selling 2% of a stock of a company's
and it was often more than that at that time. It was often maybe 10%, and it wasn't huge companies. It was often mid-sized companies, Fortune 500 companies, but not the biggest ones. And he could go to the pension funds and say, will you give me your proxy votes? So you could go to the mutual funds and say, will you give me your proxy vote? But what happened, and it wasn't necessarily just the work of Icahn, it was really a whole kind of community of hedge fund managers, of corporate raiders, let's call them. They transform their name into hedge funds, which is kind of more anodyne, let's say, but than being raider. But what they did is, first of all, and this was in Jang Sup's book, so it's called Jang Sup Shin, The Rhetoric and Reality of Shareholder Value and Hedge Fund Activism. And it's, if you search that, you'll see that Cambridge Element has it as, for January, a free download in PDF. And it's really, really good. It really tells the story I'm going to tell. And and no one else has told this story in this way. So basically, people have told no parts of it, but no one's put it all together, like Jang Sup has. Okay, in 1988, there was an attempt to. There was a proxy fight around Avon, the beauty products, and the Department of Labor, which oversaw pensions and under what the Employment Retirement Income Security Act, which I think I mentioned last time, which is 1974, and was regulating how defined benefit pensions could invest their money, and more allowed them to get into risky assets and making things more and more deregulated. There was a question of whether the pension funds not only could vote the shares of my money, let's say if I had money in the pension fund of the shares that were being held on my behalf, but had to vote the shares. And the Department of Labor said that from their point of view that they had to vote the shares. So that then said, okay, when there is an attack on the company, if I can go to CalPERS or CalSTRS or AFL-CIO or not the unions, but more the GE or DuPont or whatever, and their pension fund, and I can get their proxy votes. I can go to management with that voting power that's way beyond the amount that I own through the money that my fund has bought, that my hedge fund has bought. So that's a step forward for them to increase that power. Then in the early 1990s, there had been some fairly complicated acts, but 1940, the Investment Act of 1940 and the Investment Advisors Act of 1940 that had tried to assure that this kind of thing would not happen, that people who were managing money wouldn't be able to use it to try to influence the companies. And to this day, if you're BlackRock, you cannot say, I'm BlackRock, I want someone on your board of directors. They're regulated in that way. The hedge funds can say that, but BlackRock cannot, and the hedge funds are unregulated. So the hedge funds, and this becomes part of the story, they were not, at this point, controlled under the Investment Act and Investment Advisors Act of 1940, because the rule was that if you had less than 100 entities who were investing with you, who had given you their money, then you didn't need to be regulated. And the rationale for that was that these are sophisticated investors, have wealthy people or funds that have lots of money, so you don't need to worry about that. So that existed in the early 90s. So that was a source of how they could get funds without being regulated. But one of the regulations that was applied to them that they wanted to get around was that they couldn't engage, that there was questions about how much they could engage with management. And they established that they could engage with management, this kind of thing that Carl Icahn had been doing. So they got a much freer rein for doing that. But then what was really important in 1996 under Bill Clinton, was the National Securities Markets Improvement Act. Of course, you always have the names of things that are doing just the opposite, or they're improving predatory value extraction. Because one of the things that act said is we're lifting that not that cap of no more than 99 investors. You can have I think it might be 500 or unlimited. I'm not sure, but in any case, it greatly increased the money that they what's called assets under management that they could have, and still be unregulated. Okay. So that was a huge increase in the amount of the war chest that a Carl Icahn could have when he went after the companies. And the bigger the war chest, the longer the staying power, the more likely you're going to get proxy votes, etc. Okay, then in the 2003, which really kind of sealed the deal for the hedge funds, was the Securities Exchange Commission, which from 1982, when it allowed stock buybacks, I argue became a promoter rather than a regulator of the stock market. And notwithstanding Gary Gensler being in there and trying to do some things under Biden, it's still a promoter of the stock market, not a regulator of the stock market. It took that Avon letter, the of 1998, and that applied it to all institutional shareholders, including, and it kind of solidified that argument that it didn't say that you have to vote the shares. It said if you don't vote the shares, you have to give an explanation why you're not voting the shares. So for let's say again, call it CalPERS, then you can say, okay, we'll vote the shares, and we don't have to start explaining why we're not voting the shares that we hold. And of course, they're holding shares in lots and lots, thousands of companies, perhaps. So they don't want to deal with this. Now that then created a role for a new kind of actor, and there's two of them. One is called Institutional Shareholder Services, and one's called Glass Lewis. Have you ever heard those names?
No. Have you?
Okay, and I probably most.
I've heard the word Glass Lewis before, but I couldn't tell you what it
Yeah,
means.
you wouldn't know what it was.
I heard
Okay.
Glass Steagall. Same
Yeah,
glass?
Glass-Steagall's that's different. Those were some members of Congress who, tried to who separated banking from investing. So it's important story because in the late 90s, also that separation of commercial banks and investment banks, when Larry Summers was in there, Robert Rubin was in there, they got rid of that separation too. So everything was going toward just letting the money go in, flow around the company, and be in the hands of people who wanted to be predators once they got at the company. And so they said that basically, as soon as that ruling was in place, and this is where the real power of hedge fund activists comes into play, as soon as that ruling was in place in 2003,
to be clear, the rule that comes into place is that these pension funds have to either vote or explain why they're not going to vote. That's the rule.
Yeah, that's right. And it applies not just to pension funds, but mutual funds, and Vanguard, any type of institutional shareholder. So for them, they then say, well, okay, if we're going to vote the shares, then you have to. You don't need to vote shares. You have to say, am I for or against this? The biggest thing is, are you for or against the board of directors, the slate of board of directors that are being put forward? And that's, if you can change the board of directors hire the CEO and fire the CEO, you can change who controls the company. And even getting one for the hedge fund, getting one of their people. And this is the thing that's, for some reason, nobody gets upset at that. They might hold 2% of the shares, but there can be a board of directors have 7 people on it, but they can say, we want one of our people on the board of directors. Somehow that's okay. But that's in part because they have the proxy votes too. Okay, so ISS had been around from the late 1980s. It was created originally by a guy named Robert Monks, who was believed, and who I've met several times, and believe that shareholders really should take responsibility if they're going to vote shares and hold shares in companies. And he actually, as part of his career, he had been from Maine, a business person. He had run, I think he had run for the Senate and hadn't won at one point. But in any case, in the mid 1980s, he decided that he wanted to set up this kind of advisory service. So under Reagan, he got a job at the Department of Labor supervising pension funds, which he knew he's only going to be there for a year to give him both inside insight and the credibility to be advising on pension funds. And then he set up ISS, Institutional Shareholder Services. He later sold it early 90s for about $5 million, but it still existed. Okay, they then became a huge business from 2003. So they have about 2/3 of the market, advising companies, not just in the United States, but around the world. So on their website, it says they're advising 48,000 meetings and, some multiples of millions of ballots or whatever, and they have about 3,000 employees, about half of whom are doing research. So
and the advising in this situation is they're showing up to these board meetings.
No, they don't show up to the board meetings. What they do is some more definite. Companies put out something called a proxy statement. It's called Definitive 14A is the name of the form. that has to be filed with the Securities and Exchange Commission prior to their annual general meeting, which is the annual meeting of shareholders. Okay. And in that proxy statement, it tells you a number of things like executive pay, and it tells you things that have to do with who's on the board and who's being proposed to be reelected to the board. And then if you're a shareholder, you can say, I want to have a question. Want to have a resolution that's voted on the proxy statement. Now, shareholders in general, which is something that isn't well known, cannot go in and propose, let's say, I don't think the executive should have gotten this pay. There's an exception now to that, but I'll come back to that, which is as a result of the Dodd-Frank Act of 2010, but it's not a very powerful one. But they because that's a normal business practice. That's just something that the board decides, or we don't think that they should acquire this company. But if you say that it's something that has a social purpose, that we think that the corporation is breaking the law, that it's discriminating against people, that it's polluting. Actually, as a shareholder, you can go in to say this is a business practice that we don't think this company should have, either because it's illegal or given it a bad reputation, and this is not a normal business practice. Normal business practice in the United States, just the making of decisions by those who exercise what I call strategic control, which is really the top executives, CEO, CFO, and the chief financial officer, and the board of directors. That falls under common law, and it's called the business judgment rule. So there's a rule that goes way back, started the famous case involving Henry Ford in 1920, that says that the person who is managing a company, doesn't matter whether the owner, a private company, public company, shareholder or not, the person who actually has to make the decision about how to allocate a company's resources, if they've been put in place to do that, then they have the right to make those decisions. If the board of directors, again, it could be a private company or a public company, doesn't like the decision they're making, they can fire them. That's their prerogative. But shareholders themselves cannot come in and just say, we don't think the manager should be doing this particular thing. They can, insofar as a representative on the board of directors, try to get them fired. But okay, so the what's on the proxy statements has to do, and it also can involve things like the term of shareholding, of directorship. So things that have to do with directorships, those can go, is that, the kind of the constitution of the company can go to shareholders as well. Okay, but obviously the insiders have a lot of control over that. And then when they put out the proxy statements, it'll always say, here's what such and such might be the AFL-CIO, might be an individual has proposed, and almost invariably it will say management opposes this this vote. Please, vote against it, and they'll give their reasons why. Okay, so that's in the proxy statement. And so basically, what the institutional shareholders are doing, and then Glass Lewis, which was started by Canadian pension funds, has its headquarters in San Francisco, but they were doing it for their own funds, and then they made it into a business. They have about 1/3 of the market. They're much smaller. They have last I looked, something like 300 people doing research in those companies, or something really small, but advising companies about having about 1/3 of the business around the world. They will look at the propositions in the proxy statement, and they will then advise how they think a shareholder should vote. Okay.
And do you have to sign up for this? So you said it was Glass Lewis and ISS are these two organizations that are doing this. Do you have to sign up to get their advice? They just freely disperse it to shareholders?
No. They get, okay, if I just go buy shares in Apple, and I want to vote those shares, and I think I need the advice, want to follow the advice of ISS or Glass Lewis. That's not going to cost me anything. It'll be public knowledge. Okay, but if I'm BlackRock or CalSPERS or either asset manager or a pension fund, then I'll pay to get that advice.
Like ahead of time, because if it's public knowledge,
Well,
do you mean that you pay them to do the research on the company that you're interested in?
Well, yeah, you'll be paying them for the advice. They'll give you more than just here's how to vote. They'll give you the reasons why.
Got it.
There'll be much more to it than that. I'm saying, and even then, when I said it's public knowledge, I'm not sure to how much it becomes public knowledge if there's a proxy fight, and like around Elon Musk's pay package, which I can talk about later if we get to that kind of thing. ISS and Glass Lewis, I think one point we're voting for it and then against it. But basically, that's when it becomes public knowledge. But what the reasons are, that these companies will have subscribers but what it also means is that.
And hold on, one more clarifying question. And so you're saying that this is a consequence of this 2003 decision about the fact that these funds have to vote or express the fact that they're not going to. And so basically an entire field of business has sprung up whose job is now to be like, oh, great, this is how you vote. Now I have a business where I do research and I tell you what the best decision is.
Yeah, and you don't have to do it yourself.
Okay, and so.
I should say that BlackRock and State Street and Fidelity, they probably do some of this themselves as well. They do some of this themselves as well, but a lot of them don't. So the point is that once you've lined that up, you start having this credible threat of and it's easy for the hedge fund, totally unregulated, to go lobby the proxy advisor. Just go to their offices and say, we think you should do this. We shouldn't know, we don't know anything about that, but I've seen reports of it. But that, so that's all going on in the background as the power plays, basically. And the result is that the CEO of any company, unless they have like Alphabet, Google, or Meta, Facebook, have dual class shares, which means that they have a structure that gives them more than 50% of the voting power, which I can explain. But they're scared shitless of the hedge fund because they're here the CEO is at the pinnacle. He or she is now running the company. They don't want to be thrown out. So they want to keep these people happy. And one of the ways they keep them happy is doing the things that keep them happy is doing massive amounts of buybacks and to some extent dividends, but massive amounts of buybacks. And so that when they decide to cash out, the stock price will be elevated. It's not just the timing, buy the shares today, sell the shares tomorrow. If they know that Apple's doing, last year did 94 billion of buybacks, they've done an average of 60 billion a year over the last 12 years. They're going to do that for the next 12 years. Then that stock price is going to be constantly being buoyed up. And so if they want to hold the shares longer, they might hold the shares longer. They don't always get it right, but basically that's going up. So I'll give you, then with that power, they can basically, the outsiders are there and they can get the insiders to do what they wanted to do. So I'll give you one example that we did research on is General Electric, which is kind of an iconic company. Was created by a merger in 1892. It was one of the 30 companies on the Dow index for years until recently. A tech company that had all kinds of technology inside it. I think I talked about this last time a little bit under Jack Welch, who came in 1981. He said famously when he became the CEO, Jack Welch who now many people see as being a real problem of American capitalism in the the 80s and 90s, was seen as being, well, this is really how American capitalism should work. This guy goes in there, shakes things up, and gets things done. He laid off lots of workers in the 1980s, and they called him Neutron Jack because after he was done, the people were gone, but the buildings were still standing. Okay, he came in famously at the St. Pierre Hotel in New York in 1981, just after he became CEO. He actually had a PhD from University of Massachusetts Amherst. Well, he'd gone to University of Massachusetts. Maybe it was from some other place, Illinois. But anyway, he had a PhD in plastics engineering. So he wasn't himself a financial guy, but he rose up through the ranks. And he said, we're only going to stay in industries in which we're number one or number two. By that time, GE was in maybe 100, 150 lines of business. But they were already number one or number two in jet engines, in health equipment, like X-rays go way back, and in power systems. And actually, those are the three businesses that recently, to get to the end of the story, and I'll fill in the middle, that have now been spun off. And the third part is being as three different companies as a result of a hedge fund coming in. The spinning them off in and of itself is not necessarily a big problem, but how that happened and how the company is weakened is. And it didn't start with the hedge fund; it started with Jack Welch. So Welch, as he was doing this, he actually never in the annual reports, while he was the CEO from 1981 to 2001, said we're running this company to maximize shareholder value. When his successor, Jeffrey Immelt, who was also he came from I think the healthcare division, he came in. They started being real shareholder value oriented. It was a well enough ingrained ideology by that time. This is in 2001, but Welch acted like that was what was important. So he started buying back lots of stock, contrary to this to boost the stock price. Contrary to what he had said in 1981, in the 1990s, he was constantly acquiring other companies and then selling other companies, doing financial engineering. In the late 90s, he was doing 100 to 150 acquisitions a year. And a lion's share of the profits of General Electric would be made by something called GE Capital, which was just often leasing stuff, doing various things which had a financial dimension to them rather than producing the jet engines, the health equipment, and the power systems, and everything else. Wind energy, they got into all the other stuff they're doing. GE Capital was making them a lot of money, and their stock price was up. He was getting rich off of this. He had all kinds of perks and other things. Anyway, so he then retired. Immelt came in, did the same stuff, financialized company, but one that had a lot of technology inside it, and so could still create value in a lot of industries, generate profits. In 2009, they started running into trouble because of the financial crisis and because of GE Capital with the financial crisis, because of that part of the business, not so much because of the productive side of the business. And it turns out that they had bought back shares in early 2009. I think the number was something like $60 a share, $30, $60 a share. And then in October of 2009, when the financial crisis, this might have been 2008, when the financial crisis really kicked in 2008. Later in that same year, they had to actually sell shares at half the price, about $30 a share, because for them, what was important is that they wanted to keep their highest credit rating on their corporate bonds, and so they had to find some other source of money. So they actually, in a very short period of time, went from buying shares at twice the price that they ended up selling them for, 6 months later. Okay. They then nevertheless started getting into trouble at that time. Immelt's trying to turn them around. They're still doing a lot of stock buybacks, trying to keep their stock price up, but they are kind of stumbling along into 2014, 2015. Now at that time, there's this guy Nelson Peltz out there, who's one of the most active hedge fund managers, activist. I first came across him because in 2015, my group, AIRnet, the Academic Industry Research Network, we did a study for the Services Employees International Union, SEIU, on they were trying to organize workers at McDonald's. And McDonald's have been doing all kinds of buybacks. And it was the first union that said maybe if they didn't do so many buybacks, they could pay their workers and the workers more. And of course, McDonald's was fighting against minimum wages and all this stuff. And they were trying to unionize. So they actually, and it's the only point to this point when I know that a union actually made their campaign, and then they went to the annual general meeting and picketed on this grounds around stock buybacks. I was very kind of like this. You must know William Barber III, who's a great, the Campaign for Poor People. He wrote an op-ed called "Why We Were Marching," and including our stuff on buybacks and in there as being an important way of trying to get better pay for workers at McDonald's. Now, it turned out one of the interesting things was that McDonald's runs on a franchise model, and so the franchisees were also getting kind of pressured by the corporate office, because as McDonald's was doing buybacks, the franchisees were not getting as many resources from the central office to do advertising. There was creating more franchises that were competing with each other in close proximity, all kinds of stuff. And they were feeling the pressure from below that the workers might get higher wages, either by unionization or minimum wage, and from above because the corporate office now it wasn't like under Ray Kroc, who had built up McDonald's, where the franchisees were his partners. Now they were people to exploit as well. So around that time, I got a call from a person who identified herself as a franchise that she was held. Turned out, I looked it up, about 30 franchises in Wendy's, and she was the daughter of the founder of Wendy's, and she had organized what she called the old-fashioned.
Was her name Wendy?
No, she was apparently there's another daughter who
different daughter.
Yeah, but one of my daughters did a spoof song that I wrote. The Beach Boys song, Wendy, Wendy, what went wrong? We've been together for so long. We did a spoof song on Wendy's, what went wrong? I never saw a franchisee cry till they got raided by a hedge fund guy. Wendy, but anyway, you can have some fun with this stuff. But okay, so the thing is that's where I discovered, back to the main point, discovered Nelson Peltz. Nelson Peltz, through a hostile takeover, had taken over Wendy's and was just pumping money out of it and building his war chest. And in 2013, it's called Trian Partners, TRIAN. And it's just a few people, working with him. They went after DuPont. Again, an old company, actually goes back to the 18th century, chemical company. And they wanted them to maximize shareholder value. DuPont was already doing lots of buybacks, feeling the pressure of doing this. They were run by a CEO with a science background named Ellen Kuhlman. There was a proxy fight. There was actually a proxy fight. It didn't go to just threats. It went to a proxy fight where Peltz lost, his side lost. But Ellen Kuhlman then wrote an article that said there was a shadow board at DuPont, that he had created certain allegiances with people on the board, to his point of view, that was going to work against her. And sure enough, on October 15th, 2015, she was kicked out. They had lost the proxy battle, but she was kicked out. And Peltz put, I think, someone on the board there. And then Peltz and a guy, Galliano Loeb, merged another company, Dow and DuPont, broke them apart. They merged them, broke them apart, and made money out of the deal. We've been working on that story. We haven't written it all up completely, basically, and just making money out of money and destroying companies in the process. Okay, October 15th, 2015, the same day that he ended up actually winning, but not by proxy, but by getting rid of the CEO and putting in someone loyal to him. It sounds a lot like Washington D.C., doesn't it?
Is this still at DuPont?
This is at DuPont.
Okay.
The same day he announced that he had bought $2 billion worth of GE shares. Now, what the MO of Trian is, they write a white paper, which isn't stupid at all, but could have been written by a good graduate student, about what GE should do and should not do to maximize shareholder value. And so there's this notion that they're actually going in there and know something about the companies and know it. Okay, but what it really is they want to go in there, and it was quite clear in the way they made the demands. They wanted to see the share price double in a year and cash out. Okay, so at that point, Jeffrey Immelt, CEO, I can't help thinking, when I think about that, thinking of like what's going on with Zuckerberg and Bezos and all these people. He wrote a thing on the website saying, Nelson Peltz is a very constructive, very constructive. We're going to cooperate with them. And they both were excited of saying, yeah, buybacks might be a good thing to do. Okay, so in 2016, the first full year in which Peltz held the shares, they had an $8 billion profit. They had actually had about an $8 billion loss the year before, which came about through part of the problems of getting rid of GE Capital and restructuring. But now they had a profit, but they did about $8.5 billion in dividends, so more than 100% of their profits went to dividends. But they did $22 billion in stock buybacks. Okay, and that was a big play to get the stock price up. But I think, and probably Peltz would admit this, I don't talk to these people, but they went too far because the company could not, just was in financial trouble, and the stock price didn't go up. The next year they had to cut the dividend. So meanwhile, the beginning of 2017, there's rumors, and then that Peltz want Immelt out. Now, Peltz never had more than 0.9% of the shares, okay, of GE. But now he's the one who's calling the shots. He's Peltz's daddy, and he's saying, and so Immelt resigns, okay, and he says he's like 63 years old, and he says, well, I've been here long enough. No, that wasn't what it was about. And actually, there's a very good article in Harvard Business Review. Someone's really,
Do you think that he just didn't want to fight anymore, and he just?
Oh no, he didn't have a choice. I mean, yeah, the board was against him, and Peltz had secured their influence, and then Peltz put his son-in-law, a guy named Ed Garden, on the board, and see, even if you just have one person on the board, you have all the inside information. Exactly, you can influence other people directly. So this is really,
How is this not illegal? Like, this is the part that I don't understand.
Well, okay, so this is the largest travesty. Let me just go to on this point, because there's some stuff we recently did on Elon Musk. Of course, he's of interest to everybody.
Yeah, let's wrap the Peltz and Immelt story.
Okay. So let's wrap that up. But let me come back, because this has to do with boards of directors, and we're starting to get into a lot of research on this. It's a little difficult to do, but we're in terms of getting the numbers. But okay, with Peltz, what happened was basically, and he's on record of saying, I should have sold the shares earlier, that he missed some of the opportunity when they initially went up after that buyback, so he should, but he held the share. So then he got other executives in there who would do his bidding and basically then push them. Maybe we can make money if this is split up into 3 companies. I haven't checked recently whether he did or he didn't, because we follow these companies. We don't, just a small group of people. We don't have a lot of time to follow up everything. But basically that whether that was good or bad to do, it was a position that GE was forced into doing, and it laid off lots of workers. And basically that money had gone out the door. $22 billion in buybacks, and actually was done as what's called an accelerated share repurchase, where they do a contract with the bank to buy the shares over time, but they do all that $22 billion on one day, and so they really get a spike in their stock price. It's a little complicated, but basically it doesn't violate the rule of 25% average daily trading volume on one day, because they're not actually doing the buyback on that day. They're just retiring the shares that are borrowed from institutional shareholders by the bank, and then the bank over time actually buys back the shares and gives the shares back to the institutional shareholders. That's a trick that was created by Salomon Brothers in around 1994. There's all kinds of tricks like this that that have to do with just letting the predators basically tilt everything in their favor and make money out of it, even when things are going bad. Okay, so GE is a company that's stumbling along, that has important technology. They're one of the leading, still number one, or probably number one in aircraft engines. They're still huge in power systems. They're still big in healthcare, but now those are separate companies, but much smaller companies. And a lot of money was made by people who were, or tried to be made by people who just were doing these financial maneuvers.
Hey folks, quick interruption. Remember, this podcast is entirely supported by you, which means we work entirely for you. But you have to come over and check out our Patreon page at patreon.com/demystifysci in order to keep this thing going. So check it out and enjoy the rest of the conversation.
So if I was to give an arc to the conversation so far, what I've gathered from it is I've understood a lot better the way that hedge funds are able to come into companies and significantly change the course of what they would do in order to maximize shareholder value. Where you basically have a company that has a board and CEOs that are going along one track. Somebody realizes that they might be able to play the system, and so they organize these votes in order to be able to force the company to take a series of actions that they think will raise share prices, which then allows them to share the stock, or to sell the stocks, or to buy the stocks at the right time in order to generate profits. Do you think that that's like a fair...
Yeah.
Okay.
Yeah. Except I would just add to that the result of that is that companies, when they start becoming profitable, they just start doing this stuff on their own to keep the activists at bay, or to keep them, so that they don't start attacking the company. And so, for example, recently, NVIDIA, which has been the highest flying stock out there, and driven mainly because how profitable it has become with the AI chips and a lot of speculation, but they've also started doing the manipulation side. They've started doing huge buybacks, including a recently announced a $50 billion new buyback program. So they've been doing tens of billions of buybacks. I don't think that's because Jensen Huang, who is the CEO of the company, built up the company, wants to do buybacks. I think it's because he has, last I looked, something like 3.4% of the shares, and so he himself could be kicked out if he doesn't, quote unquote, maximize shareholder value. So I think that's what's going on in Apple with Apple's buybacks. They had a rate on, well, not Carl Icahn bought some shares in Apple in 2013. had dinner with Tim Cook, made a much publicized demand that they do 100 or 150 billion in buybacks, and then the next 2 year Apple did record buybacks, and they've been doing them ever since. Actually, to the great benefit of Warren Buffett, who's used Berkshire Hathaway money to make about $160 billion off of his about a $40 billion, $38 billion shareholding. Basically, so the companies are often doing this now. This is why all the companies are doing this. They're competing to get their stock price up, but they also want the CEOs, quite apart from the fact that their own pay can benefit from this, which could be enough incentive. They want to make sure that they stay in those positions. And so the whole thing accelerates. And so it doesn't come to the hedge fund campaigns or the activist campaigns. They're really just the part where you're striking fear into all these companies that these guys are going to come after you.
Okay. So first, a clarifying question. What is the difference between private equity and hedge funds?
Okay, so that's let's get into that. So you see, here's what I think has gone on over the long term, and we talked at the beginning about the measures of inequality, and there's no doubt. I mean, the measures. Let's say the Bernie Sanders gives all the time whatever he's talking about. He was talking about H-1B visas yesterday, but it's always in there. 3 people own more wealth than the bottom, or something like that, than the bottom 50%, or but basically the data on the top 1/10 of 1% of wealth holders, vast amount of wealth relative to the lowest 50%. I also looked at the data on the wealth holding, what that consists of, what the assets are, and it's actually gone up from around 1989-90, when it was of the top 1/10 of 1% of wealthiest households, or by net worth, assets minus liabilities. It went up from about 14% was in the stock market. Now it's about 45%. So more and more money, that money is in the stock market. Okay, so here's what's going on: is you have more and more people with the deregulation of the economy, with the help of the SEC and the license of Route 1982 Rule 10b1, 10b18, buyback stock, with being able to go break up companies, basically take all this value. People go to work, tens and tens of millions of people go to work every day, create value, and someone else is grabbing it. Okay, that the most is being grabbed by the most profitable companies. So let's say of S&P 500 companies that did about $7 trillion in buybacks over the decade 2014 to 2000, I think it was 6.8 trillion buybacks 2014, 2023. The 50 of this, 1/10 of the companies did about 55% or 56% of the buyback. So it's the most profitable companies that money, and that money could be used in other ways. It could be paid to pay workers more. It could even be just kept in the corporate treasury, because and that doesn't mean it would be lost to the economy, because they'd be buying stocks and bonds, and they'd be buying other stuff on with that money. It wouldn't just be sitting there idle. But this is the way they're using it to manipulate the stock price. There's a small group of people who are in the position of reaping the most gains from. I mean, stock holding is concentrated anyway in the U.S. economy. It'd be much wider holding of stock if more people had better jobs, higher pay, more discretionary savings, etc. But that's part of this concentration of income at the top. Okay, that money goes into people who want to make money out of money, and then the stock market isn't enough. They're looking for other things. Okay, so that's where private equity came in. They said, okay, let's go not just after the good companies, let's go after the distressed companies that have a lot of debt, take them off the market, squeeze what we can out of them. Maybe we can put them back on the market. Maybe they'll go bankrupt after we've laid off all the people, have what they call a dividend recapitalization, have the company borrow lots of money, pay me, the private equity firm that owns the company, huge dividends. They now have all this debt to pay off. They can't pay it off. Well, the shares are worthless. We've made our money. If the shares aren't worthless, we can sell to some other company. So there's all this financial play going on. The other thing that's going on is that we know about the subprime crisis, right, of 2008. Frankly, I was looking at all this stuff. I didn't know much about it. Not very many people did know about this whole subprime market that was developing until it crashed. Okay, but what that was ultimately about was, there was acts that were trying to get home ownership to lower income people that helped that out, but it was basically people who, call it Wall Street, whatever you want, people who had access to this money, often through hedge funds or Wall Street banks or Goldman Sachs, etc., saying, let's go and see if we can make money out of this sector. In this case, it was housing and subprime loans and selling off the tranches and stuff that should have been totally illegal. People should have gone to jail over. The credit agencies, sort of totally defrauding people. Basically, that crashed. Now what they do is they buy up those those houses, so they own the housing stock directly, rent it out. But that device it doesn't seem to be there as much, the subprime lending. But they look for other things. So one of the things they've looked for, private equity, over the last, I would say, really accelerated over the last 10 years, is healthcare. So we have a paper that's online at the Academic Industry Research Network, which the organization I run, and called The Attack on U.S. Healthcare. And so we said there's a kind of a public equity attack and a private equity attack. So the public equity attack is the ones that are publicly listed on the stock market, and we show the pharmaceutical companies, the insurance companies, including United Health Group, which United Healthcare was part, where the CEO was killed, murdered. They're doing tons of buybacks. They're just there. We pay higher drug prices, higher health premiums because they want to get the stock price up. And anything they say to the contrary is total bullshit, because that's what they do. And the pharmaceutical companies are spending often over a decade, Merck, Pfizer, 200% of their profits on buybacks, until it comes a point maybe when they can't. But basically, anytime they have the profits there, that's going to prop up stock prices. It's not going to invest in innovation. Okay, so that's the public equity side of it. There's also companies that are distributing healthcare products, et cetera, that are totally financialized. But then there's the private equity side. So if you think of it, if all this stuff could not have been built just on private equity. The public companies were the ones that are mass producing products, are really profitable. And so they're the ones like Apple's and Microsoft's and Intel's, et cetera, when it was profitable. I can come into the case of Intel now, which we're doing a lot of work on. But when they are profitable, they're just sucking that money out there, and it's going to people who are just trying to make money out of money. And it might just be the CEOs who now have $20 million or $40 million more, and what are they going to do with it? They've already bought 3 homes or whatever, so they're gonna just look for some place to put that money in to get a high yield on that money. Okay, so some of that money will go to the private equity, and all that means is that they're not investing in publicly listed companies. They're investing in companies that are not on the stock market. And what they've done in healthcare is they've gone after hospitals. So hospitals, often which were nonprofit, some of them ran into financial difficulty, and so the private equity comes in and sort of pays off the debt and does certain things. But then they do stuff with the hospitals, which was in Massachusetts, where I live. It's been well documented with Steward, which has had to close down a lot of its hospitals. They sell off the land, and then to get the companies, they have a stake in the real estate company, which then rents the land back to the firm that they own, and they're making money, from the rents on the very properties they own, which they've sold off the land and forced them to pay the rents, and so they're squeezing these entities. Okay, what do they do when they squeeze them? They start offering, in the case of a hospital, the healthcare declines, the quality of the care declines. Or they're buying up doctors' offices and the doctors are saying, people, okay, you have your 5 minutes, you have your 5 minutes, blah, blah, blah. They're keeping track of this. Not everybody, often you don't know if you're going to a doctor, whether you're going to a doctor who is actually practice is controlled by private equity. And there's a couple really good books that came out, I think it was just last April. One is by Brendan Ballou, Ballou, called they both have the name Plunder in it, and it's about private equity. The other one is by Gretchen Morgensen, and his name is Rosner is the last name. They have a book also which is about private equity, about plundering, and so they have that side of it. There's a couple people I know very well named Rose Bott and Eileen Applebaum. They wrote a book in 2014 called Private Equity at Work, and that was inspired by Mitt Romney running for president in 2012, saying he was a job creator and Bain Capital, and a lot of people at the time, and they kind of documented this and went beyond it to say, well, no, these people aren't necessarily creating jobs. They're actually just making money themselves, or often destroying jobs. It's not the case. You can find some private equity companies that actually do help companies finance a turnaround with them. And sometimes it's beneficial, but a lot of the private equity out there, I'd say most of it is just going out to make money, and it ends up in ways that ends up kind of compromising the product quality. When healthcare is very important, they're compromising product quality and squeezing the incomes of the people doing the work, particularly the people who are less represented, less powerful in terms of defending their wages, etc. So they become bigger and bigger. They're not as visible as hedge fund activists, because the companies are not reporting. They don't have annual reports, although a lot of the private equity companies are listed on the stock market. So you can see a little bit about the companies in that way. They themselves have listed on the stock market. But basically there's this giant value sucking machine that starts with the profitable companies doing buybacks on top of dividends. People who just are there to make money out of money, either as a profession or just because they have so much money, that's all they can do with all that money they have. And they then look for new ways of making money out of money. And one of the results of that is that, well, this is one reason I think the stock market is so bullion, is so bullish, basically, is that there's actually less stocks on the market and a lot of money looking to make money out of money. And so money keeps rushing into the stock market. Anything that looks good, really gets a big boost. And you're getting these, $3 trillion valuations and things like that. So that's what's going on, more kind of the more macro picture. And private equity has become a part of that, but not, I've looked at, there are data from the Federal Reserve on what I mentioned, the asset holdings of the top 1/10 of 1%. They have different, the top 1%, the top 10%. I just looked at the top 1/10 of 1%. I'd say the private equity of their total assets, about 88% are financial assets, of which of the total assets, I think it's something about 45% are public equities, stocks, and about 30% is called equity in a non-corporate business, which is I take it to be largely private equity holdings. That's at the house measured at the household level. So it's a lot of money out there, and it's a lot of additional wealth of the top 1/10 of 1%, or whatever measure you want to take.
Wait, can you give me that breakdown again? So this is individuals, or this is?
Yeah. So this would be households.
Okay.
And
so the top 1% of the top 1% is what we're talking about?
Yeah. 1/10 of 1%, but 0.1%. Okay, so they're of their total assets, I think the number is about 88% is financial assets. Okay, so if you look at the bottom 50%, it's maybe 10 or 12% or 8% or something like that is financial assets. Most of the bottom 50% is real estate holdings. And so if you look at just the real estate holdings of the top 1/10 of 1%, which of course is was that the 500th of the bottom 50%, they have probably as much real estate holdings, but it's not as much of their total holdings. But their total holdings is mainly financial assets. And of the financial assets, if you take that 88%, 45 of that 88% would be stocks, and about 30% would be private equity, or what I interpret to be private equity from the data. So it's about 70, let's say 75% of their total assets are coming that they're making money off of are investments that they have in stocks and or mutual funds or private equity business. Now, some of those may be businesses that are not what we're talking about private equity as of the Mitt Romney type, of Bain Capital type. They might just be businesses that they own, wholly owned businesses that they run, but a lot of it is businesses that they own, and it often what the Ballou and Morgenson and Rosner book show, both of them, is that ownership is often very opaque. There's a whole bunch of layers there, and so you don't really know. And so that way they actually, when there's violations of, laws or pollution or this or that discrimination, they're not taking responsibility in terms of the people actually grabbing the money. It's down at that unit, and they say, well, we just have some shares in that company. In fact, through a holding system, they are really controlling those companies.
Okay, so a question that I had, the devil's advocate question that I had was: is it really so bad for these companies to be rated? Because let's say that you have something like GE, which has been in existence since the 1800s, and it's just kind of gotten to the end of its useful life. It still has some control in the market. Yeah, it still has some ideas, but at this point, it's holding up a lot of intellectual property. And so when somebody comes in and breaks it apart and spreads the intellectual seeds through the landscape, does that not over time give new companies the ability to grow up in that space? Yeah.
So just stated that way, it could be correct. And so that's why I said the fact that they split up into three companies isn't necessarily, from a productive point of view, a bad thing. They can be focused on healthcare, they can be focused on energy, they can be focused on power. Okay, but and so there's no doubt when companies grow too big, and that's in part what happened with GE itself. When Jack Welch took over, it becomes this unwieldy conglomerate, and that's why when you started taking companies through leveraged buyouts out of the conglomerates, that was often a good thing to do. If it was a management buyout and the managers really said, this is a company where I built my career, I want to continue building my career, but I can't be part of this conglomerate. Even if it's going to cost us, we have to pay 12 or 15, even 20% for the money in order to get the loans to buy ourselves out. Let's get separate and see if we can make it on, but first of all, our society could make that much easier to have the people who are, because really what you're talking about, so I have what I call a theory of innovative enterprise, this whole theoretical framework, which should, but isn't being taught in every economics department around the world, but that's my opinion. That basically which really gets at how business enterprises create value. And there's three things that they need. They need to have strategy, organization, finance. They need to be focused on what they're going to be produced. So that relates in part to what you just said, that they can be more focused. But really, what the essence of is organization, what I call collective and cumulative learning. That you have people who are work together and know that they work and know that they can benefit from working together. Okay, and that's what creates value, and that's a very hard thing to put in place. It's an easy thing to destroy if you just come in, and that's what hedge fund activists often do, and that's what CEOs, even without the hedge fund activists, are often doing. So yes, if you can create smaller units, more focused units, more strategically focused units, do that, and then you have the finance. The finance should just be enabling; it should not be dominating. Okay, and so the purpose of the firm should be to produce a higher quality, lower cost product. And in doing that, what I said right at the beginning, the way to do that, I would argue, is through some version of what I call progressive value creation, by creating value with the people who really matter. And I probably said this last time, the stock market historically has not been a source of funding for companies the way in which you took money out. And so it's if you can create, and actually if you look at companies that have become successful, it's often that they have had some version of this progressive value creation to the point where all the profits are there, and then someone comes in and says, "Oh, those profits are mine," and that was the shareholder value revolution, which, as I might have mentioned, I was at Harvard Business School in the mid '80s, and I think I've said this last time, 1984. They weren't talking about shareholder value in 1986. Meanwhile, they brought in this guy, Michael Jensen, who basically said companies should just disgorge the free cash flow. This were his terms. Okay, disgorge is really saying the money that is in the company shouldn't be there. Well, maybe it's there because people work for decades creating the products that are making that, and they expect that their careers, as was the case before, were going to be secured by that, and their pensions were going to secure to that. Someone's coming in, and what they did was, with that argument, they changed the whole rules of the game. So now it went from what I call retain and reinvest to downsize and distribute. And this was totally legitimized by these assholes, basically, at Harvard Business School and other places, who later, in Jensen, just before he died about 25 years ago, he said, "Oh, I think maybe I was wrong about this stuff," after all the damage was done. Okay, basically, that still totally dominates out there. Our organization is, really is thinking of starting something where we can disseminate this information better. But basically, what the message that we would like people to get out there is that you don't know it, but most of the companies that are out there, particularly if they're large companies, you're working for the stock market. The stock market is not working for you, but you're working for the stock market. And I have the data. I should say also that large companies dominate the economy. So I actually printed out the table I always use here just so I could look at the numbers. In the U.S. economy by employment, this is from 2021. The census puts this out every year, and the latest data are 2021. 5,000 or more employees. Put my reading glasses on here. You have they are the business sector is about 84% of the total civilian employment. Companies with 5,000 or more employees, they average almost 22,000 employees. So that's big. Okay, there's 2,138 of them in 2021. So there's a lot, but not a huge amount. There's a significant number. They employed 36% of all employees in the business sector. By the way, I never use the term private sector because most of these companies are not private. They're public, and private just is a kind of way of saying they can do whatever they want. And they have about 41% of the payroll. So actually they pay above the average because they can afford to pay above the average. It's not saying they could pay as much as they could. Actually, the average pay per employee by these data is about $72,400. If you take the top 20 companies with 20,000 or more employees, there's 517 of them in 2021. They're about 25% of paid employees, about 27% of payrolls. they average 61,244 employees, and their average pay is about 69,500. So basically, it's not just that those companies are important. The decisions that are made in those companies about who to employ, whether they're going to lay off people, employ more people, pay dividends, do buybacks. Those are the big decisions. What new projects they're going to invest in. That really determines, in my view, the way the economy operates and performs. And get back to what economics is about. So I come out of economics. The discipline of economics, I don't think any economist would deny this, is about how you allocate resources, except most economists think that the market allocates resources. But no, it's these large corporations allocate resources. And when we get higher pay on a sustainable basis, more stable employment on a sustainable basis, it's not because there's a tight demand for labor on the labor market. Firms will find ways of doing that. They'll offshore, they'll find other sources of supply, they'll automate. It's because actually the firms are creating value and they're sharing with their workers. So one of the ways I look at it, at any point in time, there's a certain amount of revenue that comes in. And if you have profits, it means that you can do more than you did before. If you have losses, you have to do less than you did before. So this is just a period by period, take it a year by year decision, or even a quarter by quarter decision, because they have quarterly reports and they have the data. Okay, so you can decide, are we going to keep more people employed or employ more people, less people? They're making these decisions. They might go back and forth on this, but those decisions are actually determining how the economy operates. And when you have a firm that is oriented toward what I call progressive value creation and saying who really matters in this company, and it's usually not the shareholders, that will be what they prioritize. And I would argue that on that basis, they will tend to do well because they'll get the workers to come to work, they'll be hardworking, they'll do more creative work, they won't just punch the clock. We had a comment on LinkedIn because we're doing work on Intel, from an Intel engineer who used the term that when they saw the company just doing all this, well, he thought it was just dividends, it was buybacks as well, being in the pocket of Wall Street. The engineers were just coming in and punching the clock. And I've used that term as that's not what a company wants. You want people who are going to come into work, feel connected to it, and feel that they're going to get rewarded by it. And in general, when a company works, people do get rewarded because they're there a year from now, 2 years from now, etc. The company can become too big. Some of those people who are there may be there for too long, less productive. That might be part of the price you have to pay for having a kind of a motivated labor force. But that's not what happened with the rise of shareholder value ideology. First coming from the insiders, being convinced by people like Michael Jensen, just disgorge the free cash flow. Just take money that somehow the term disgorge it doesn't belong to the company, belong to shareholders. Free cash flow, it's in every financial statement now. That's a totally ideological term, because if you can lay off 5,000 workers, you have more free cash flow. So basically the definition seems to be what you need to do to replace your plant and equipment. Well, that is not what a productive company is. But productive company always, and it's not just plant and equipment. It's not just R&D. It's investing in people more generally, and that's what companies have to do, and that determines whether or not we have a middle class because of the importance of these companies in the economy. So that's what's at stake here. And so it's not just, this is a part of economics. This is economics. And I can tell you that, because we were just discussing this today, because we've made some attempt to change this, but none of this stuff is taught in economics departments. I was in the Harvard economics department a long time. I was at Barnard College and taught in the Columbia economics department for a long time. It's gotten worse since then. It wasn't ever any better. Basically, economics is really because of the way that economists think about markets. In imperfect markets, perfect markets, it has no clue. They have no clue about what's going on within business enterprises. But that's the economy. I mean, you asked right at the beginning, is economy important? And I said, economy is important, and if you don't understand how businesses operate and perform in the economy, then you're missing out on a lot. Okay, well, that's actually a long answer to your question. You wanted a short response to, but it got me off.
Shiloh, what were you going to say?
Yeah.
I mean, I have a devil's advocate question about this. So you say
Yeah.
that the companies are working for the stock market. You say this. Aren't most of the employees invested in the stock market in terms of their financial futures to some extent? And therefore, isn't that investing in the employees by proxy?
Yeah. The only problem is, okay, so it's a big part of the of the story, particularly what I call new economy companies like Microsoft, Apple, Intel, Oracle, companies that started recruiting, and I think I mentioned this last time, in the 80s in particular. They were recruiting engineers and managers from old economy companies where they just had salaries and defined benefit pensions and stuff, secure jobs. Not everybody took took up the offer, but a lot of them went to startups which couldn't offer that, because if you were Microsoft in the early 1980s, you couldn't say that you would be Microsoft even a decade later. So you weren't saying, oh, we're going to give you employment for a lifetime, a defined benefit pension. That was something that had grown up much more organically, even across the Great Depression in the United States. But this was a changed set of norms, and the way you got people to leave those companies was to have part of their pay, often substituting for some of their cash pay, in stock options. Okay, now that became a bigger and bigger portion of pay. So
I'm not even talking about stock options as pay, though. I'm just saying that most people who are making white collar salaries are investing in the stock market because they don't want to. I mean, they might have some bonds as well. But very few people are keeping cash. So most people's financial success depends on the success of the stock market to some degree. So isn't that feeding back on the employees ultimately?
Yeah. Okay. If you're investing in the stock market because you want to have a reasonable yield on your savings, okay, that's one thing. If you're investing in the stock market because you hope to hit the next winner, I mean, I could use financing for the organization I operated. I could have put some of my savings into NVIDIA 2 years ago and I studied this sector, but I didn't, partly because I don't speculate on the stock market. But if I had, I
mean, that very rarely works out for people.
That's right. That's right. So and even people are on the inside don't all see that going on. So what you're generally talking about is you have discretionary income. You could spend it, you could save it. Yes. Okay. What I would say is that what you want is company to pay you a regular stream of dividends and to reinvest the rest of that money so that if and when you decide to sell the shares, it has the next products that can compete on the market. You are not going to gain from stock buybacks, because stock buybacks are people who are timing the buying and selling of shares.
Stock buybacks just seem like pure deception as far as
that is. So my critique is not about the stock market more generally.
Mm-hmm.
I think it plays much too big a role in the economy and in creating inequality, and in fact reducing the jobs for which you have those kind of incomes that give you more than paycheck to paycheck. So they in fact have some money that you could put into savings of some kind, and that's well documented that most people do not have a lot of savings, and so and the stock holdings, even indirectly through pension funds, are highly concentrated. The figure is often 85% of stock are held by the top 10% of households by net worth. So there's something that you could have an interest in, but if it's someone else is really driving that show and concentrating their income, someone's paying for it somewhere. And I should say it's not that it's necessarily zero sum, because Elon Musk being a wealthy person in the world, it's because SpaceX is a kind of it's not on the market, so it's a less of a clear valuation, but certainly Tesla is on the market, is because Tesla has been successful. Whether it remains successful is another question, but it has been where new car company was created for decades and decades and decades. In EVs, he created a new, he and all the people working with him, I should say, but he led it. He created, okay, but so there is that value there. The question is then, who controls it and what do they do with it? Okay. And then what do you do if they're abusing that power? So let me actually give you, because I started getting into this, because basically those companies that, those, let's say, whether it's the 517 or 2,138 that have 5,000 or more employees, they're what our economy depends on. And because they also create a lot of demand for smaller companies. They are often can make or break communities. Okay, so who is overseeing those companies? Well, you have a board of directors. And then there's all this debate about people saying, should they be independent or not? Should they be staggered so they're not all working in concert, so one comes in and the other one goes out? I think that's given the structure of things, almost meaningless. So we looked at, and this is just an extreme example, but I'll give you two examples. One is Tesla, where basically one of the reasons that Musk is the richest person in the world, I mean, the basic reason is that Tesla was successful. But the other reason is that he may or may not own 25% of the shares or have access to 25% of the shares. There's been a ruling against him twice by the Delaware court that his pay package from 2018, which was 12% of the outstanding shares of Tesla, is not valid because of the way it was given out. I don't know if that or your readers have followed that, but basically it's been in the news a lot recently in the last year. Okay, basically he'd done this three times: once in 2009, once in 2012, and once in 2018. It was first 8%, then 5%, then 12% of the shares. That's a huge amount. So that was 25% of the shares. Now, obviously, at the time that they were given out, they were worth something, but they were not worth anything what they were now, because Tesla didn't have a mass-produced product. They had their Roadster, but they hadn't been the success they are now. Okay, and they weren't profitable. But actually the vesting of the shares, which is generally not the case in the United States, was dependent on them reaching targets in terms of profit, in terms of sales of cars and actually creating value. But he basically gave those shares to himself by putting himself not only as CEO, he was employee of the board, could be hired or fired at the board, but he was also chairman of the board. Now, this is a way we were studying this now because Anastasia mentioned at the beginning other systems. We're even looking at Britain being different, because Britain, that doesn't occur. And this is one thing that people often say, that the board chair should be separate from the CEO. But when they're together, obviously the board and the CEO is, it's the chairman of the entity that's hiring the CEO is the CEO. Okay, but then there's a question: is the board going to do anything that is not necessarily in the interest of the company in terms of trying to contain the CEO? And if the CEO is powerful, they may not, because they want to keep their positions on the board. Okay, so what is that position on the board worth? That's now, when I started studying this stuff, let's say in the 1970s or 80s, I don't know, it seemed, I've never been on a publicly listed company as a board, but people might have been getting then 10,000, then 25, then 50,000, maybe 100,000 fee for showing up for meetings a year. Okay, that may be excessive, but that's not going to make you ultra rich. Okay, but if then they started giving stock to board directors, and depending on how much stock that they gave them, then they could become ultra rich. So we looked at the people who were on the board of Tesla in 2018 when they agreed to this disputed pay package, and we said, how much was it worth being on the board for them? So at the time, Musk was a chair, but then the SEC made him step down for a period, and he hasn't taken it back because he sent out a tweet about taking Tesla private that was seen as being kind of roiling the market and being used to basically in trying to influence the market, and the SEC kind of slapped him on the wrist and said, "Okay, you can't be chair." So he made a woman named Robin Denham chair. She called it a life changer, being the chair of the board. I think our calculation is she has taken in $383 million, and she has about maybe 280 million still in options out there that could vest. And now the stock price is even higher. Okay, there was others, or 100. James Murdoch, I think, was $153 million. Okay, now these people are called independent directors. They're appointed for 3 years. There's a guy named Jim McRitchie who's constantly had shareholder proposals. I've communicated with him a lot, trying to get them down to 1 year. So they have to change. They can't have such a vested interest in the company. There's pros and cons to that. But basically, there was one person on there in 2018 named Linda Johnson Rice, and she did not get reappointed after her 3-year term. So she was not around when Tesla's stock price really went up. Now the way stock options work, they invest over 1 to 4 years usually. And so we calculated, because we look at the records, it's a lot of work to do this. His colleague of mine, Matt Hopkins, went in and found that her stock-based pay of these people making hundreds of million for those 3 years was $135,000. Okay, which might have been what she got in fees. If she had got her board seat renewed, she might have, in 2021, could have had stock options vesting that worth $173 million. It later came out that in an interview that she said in that period she was criticizing Musk for being often on drugs and being volatile. Guess what? She didn't stay on the board. Now this is going on everywhere because the stakes are so high. The other company we looked at is Apple. And so we got interested. Journalists would call me and I say, Apple's doing all this buybacks. Why don't you go interview Al Gore? Why would you want to interview Al Gore? Because he had, until he retired last March, he was the second longest serving board member since 2003. So he was brought in by Steve Jobs. Now, at a time when Jobs he was building the company, he was not paying dividends, not doing buybacks. I think I mentioned last time Apple had done that when Jobs was gone between 1985 and 1997. He put an end to that nonsense and said, we're investing, and we know what the outcome was, which Tim Cook took over. Tim Cook's role in doing that was outsourcing their production to China. Okay, so Al Gore was one of the people, after whatever happened with the election, he went on to bigger and better things. He became, among other things, a director of Apple. Okay, he was getting, I think it was a fee of $50,000 a year. I think that was later raised to $100,000, but he was also getting stock. So we calculated the value over 21 years of the stock that he had got from Apple just by being on the board of directors, $128 million. Okay, that's not too bad. So he's getting, what's that, 12 divided 100? It's about, divided by 21, it's about $6 million a year, something like that. 128 million. Okay, so the thing is, the question I was saying to reporters, go ask Al Gore once they started doing all these buybacks from 2013 on, which now are a total of about 60 billion a year on average. Why didn't you say anything about Apple using the money that way? Why didn't you say maybe Apple should be investing more in things like something you knew about, climate change, in other companies? Why invest with the government? Why not there's so many other things you could do. One of the things I pointed out in an article, Matt and I pointed out, was that after the George Floyd murder in May 2020, Apple in June came out and said, we're going to have $100 million racial justice initiative. $100 million is a lot of money. But if we looked at how much Apple had done, $70 billion in buybacks that year. So what's that 100 million? So okay, here is a guy, who often talks about problems of inequality, Gore, as well as climate change, sitting there on the board, doing absolutely nothing about the biggest corporate looting in history. And that seems to me to be a big problem, because it doesn't really matter who's on those boards. First of all, if he hadn't gone with the flow, he wouldn't have been kept on the board. And so that it's a totally corrupt system. It's a system, and it's not, unfortunately, it's not something that Bernie Sanders is talking about, or anybody who is progressive or AOC is talking about. There really, who is running? Now, there are a few people who have talked about it. One is Tammy Baldwin, the senator from Wisconsin. She has legislation that's been in place in the Senate since 2018. She introduced it in 2019, called the Work Act, which would rescind the rule from 1982 by the SEC to allow buybacks. So that means that all those buybacks would now have to be construed as manipulation of the market, and that all publicly listed companies should have 1/3 of their board members be worker representatives, which kind of emulates a system that's been in place for a long time in Germany. For big companies, it's a half minus one of the supervisory committee are employee representatives. Elizabeth Warren has her Accountable Capitalism Act, which from 2018 as well, I think, that would have put, for large companies, $1 billion in revenues or more, they would have been subject to a national charter, not a state charter, many of which historically went to Delaware, and they would have 40% of their board members be representative employees. I would argue that in many industries, the board members should be representative of me, the taxpayer, because we put lots of money into the companies that they use, either through infrastructure and knowledge they use, or even subsidies. You could also make the argument that in the healthcare industry, there should be advocates for patients on the boards. There's a lot. And the shareholders are the least important. There is, as I said a couple times at least, shareholders have historically not funded companies. It's just been a way of entrepreneurs have built up companies taking their money out, and that includes venture capitalists. The one exception to that is biopharma startups, where most of the innovation is going on in the pharmaceutical industry. So the National Institutes of Health spends it's $40 to $50 billion a year funding life sciences knowledge that the biopharma startups get access to, mainly through university research. Okay? And they're often close to universities. I live in Cambridge, Massachusetts, near Harvard, MIT. There's tons of hundreds of biopharma companies, probably within a 15-minute drive here. Okay, they actually, when they go on the market, they do raise a lot of money. Okay, and this is an interesting phenomenon. They raise a lot of money that can be put into drug development. And they do that often before the IPO, the initial public offering, because they go and say, we're going to do initial public offering and you'll be able to cash out then. And so they raise a lot of money. But it's an industry where the product development can be billions of dollars. It's highly uncertain about whether you're going to come up with a successful drug. But it really doesn't matter, because there's a speculative stock market. It's all on NASDAQ. And basically, if you can get to an IPO, and almost all of them, almost without exception, get to an IPO without a commercial product. They also have some money that comes in from big pharma and government subsidies, but big pharma often buys stakes in them. But then people can cash in. So take the company it's near here that we studied, Moderna, you've heard of because of the vaccine. That was a company that was just started by people who just wanted to make money out of money. At least the people ended up controlling it. And they've made billions, including a venture capitalist called Flagship Pioneering. The CEO Okay, that company went public in 2018, and what they were really good was at hyping the mRNA technology when there was no product, and those people were already super rich when the company went public in 2018 without a product. They got lucky in a sense that the pandemic came along, and they had the mRNA product. They and a company also in Germany, which is a very different type of company called BioNTech, which partnered with Pfizer to market it in the United States and around the world. But they basically all of a sudden had a lot of revenues, and people made even more money because the stock price spiked 2021. Now the stock price is way down. They don't have any new products. The venture capitalist is no interest in actually continue to invest in that company because they're going to make more company by just taking the technologies and doing new startups. And so the bottom line is it doesn't really matter whether they have successful products. There has to be a few along the way so people can say, yeah, something comes out of this. But it's like I've often said to people, because it's not the kind of thing I would do, but if you wanted to create a game, that might get business school people and other kinds of people interested, it's how you make as much money from the pharmaceutical industry without developing a product, and all the strategies you can use to hype the market, to get to an IPO, to do this, that, and the other thing. Every time there's news about clinical trials, there's some speculation around the stock. And we've actually followed some of these companies, in some cases over decades, until actually at some point they've had a commercial product, and the stock price is way lower than it was early when it was totally uncertain. So it's. Now, you could say, this is the kind of devil advocate question someone could pose to me. Well, isn't that good because they're getting money? It depends on how that money is used. So it can be true. It is true that sometimes that system is used by people who are really serious about developing the product, keeping the team together, and getting a product. But often it's used by people who just say, okay, I've made my money, so I can go. So let's say at Moderna, the chief medical officer was cashing in hundreds of millions of dollars and left before they even had the vaccine out. Now, he would have made even more money if he'd stayed around longer. But basically, people, the incentive structure is totally out of whack, and it has nothing to do with creating value. It has to do with extracting value.
I think that the difficulty of starting to untangle this entire system is that it seems to more or less work for the production of valuable goods, right? If you look at innovation from the 1970s to today in terms of the number of consumer goods that we have, the cost of said consumer goods, the ease of accessing these consumer goods, even medical technologies, the number of MRI machines we have, PET scan machines we have. Yes, there's been some problems over the course of the last few years, but it seems like it's working well. It's a system that can be abused, right? So there's tons of abuse within the system. But anytime that you start to go down this tangled path of regulations, you end up in a position where you're like, okay, well, Germany has a different economic system where it's N-1 representatives on the board stand for workers' interests as opposed to just random corporate interests. And I'm like, what has Germany made? Like, Germany seems like their economy is a real mess right now. And so it's really, really hard to look at the system that is obviously corrupt, that is obviously making people astronomically wealthy in a way that is not getting fed back down to the lower echelons of society, and say that, okay, well, we should regulate it to look more like Germany or Great Britain, because I'm like, neither of those places, both of those places seem like they're doing worse than the United States is.
Okay, let's get into this a bit. Okay, so first of all, my whole argument about the United States is really predicated on a recognition that it's a highly innovative economy. And by the way, it's highly innovative because some of those companies have been retained and reinvested and become highly innovative and employed people and created the learning. But also, the United States historically has the most formidable developmental state in history. Now,
I think that the fact that you can go to the casino and maybe you'll get the 777s and you'll be richer than God is
No,
in
yeah, but
some part a driver of that, right? Because
yeah,
it's like,
it's not just that. We have a lot of knowledge in the economy, and we attract people in the United States from around the world to through the university system, particularly, and we tap that knowledge. As with all the discussion about H-1Bs and L-1 visas, and okay, so the United States has had huge advantage, not only having its dollar being the world's currency, but having being a place where everybody wants to come to actually learn, and a lot of people, and of course, the
well,
immigrants.
also to get rich. Like, I can't say this enough. Every single immigrant that I know has come to America because it's a place where they can get rich. Like,
Okay,
it was
yeah.
really funny. We were talking to my parents the other day. We do this family chat once a week. And they were telling us about the economic system in the Soviet Union. And they were like, it was a capital crime. So centrally planned economy. They're producing, they're overproducing rugs in one region, no rugs in another region. It was literally punishable by death to go to the region that was producing rugs, to buy the rugs there, and then to sell them in the region that didn't have enough rugs. They were you could murder someone and get less of a punishment than for buying and selling rugs.
Yeah. Well, so first of all, this, I mean, is a huge, and I've studied China a lot, and both, China has, in a way, one of the most dynamic capitalist economies in the world, coming out of a communist regime. Russia does not. There's a lot of reasons for that the case, and I think a lot of it actually goes back to the nature of the revolutions, top down versus bottom up, with all the excesses of Mao, the Cultural Revolution, etc. There was a buy-in from the countryside into the Chinese revolution that was, whereas there's just total suppression of the peasantry and the countryside under Stalin. Okay, so it's a totally different dynamic. It was predatory from the start, and it never became a value-creating economy. There's no company in the world now that's a competitor coming out of Russia, except maybe commodities companies. China is totally different, and so there's a lot of learning, there's a lot of value creation going on, and part of the genius of the Communist Party in China was to figure out what parts of the from the late 1970s on of the economy were infrastructure remain state-owned, like roads and steel, etc., and what part were subject to a lot of competition, transferring technology from abroad, getting Chinese to go study abroad, come back, other people to joint ventures with Chinese companies, and that they devolved into the business sector, non-state-owned enterprises of various types. Okay, so there's a different dynamic.
But let's put a pin in the dynamic of Russia versus China, because I think that is really interesting, but we're starting to wrap down, and so I fear that I got you kind of off the subject of why people come to America.
Yeah, okay, but the point is so I started all this, my studies really looking at comparative economic development, Britain, United States, Japan, China, etc. So I'm really interested in that subject. But what I'm looking at right now is extreme economic inequality in the United States. It's getting worse and worse at having its economic consequences in the precarity of people's jobs, it having political consequences in the way that people vote, and now it's quite absolutely clear, the oligarchs, whatever you want to call them, basically kowtowing to Trump. And by the way, they may have learned a lesson from some of the oligarchs in Russia who if they were dissented from Putin, got thrown in jail. I wouldn't say that's not on Bezos's mind or Zuckerberg's mind or whatever their politics are. Okay, but this is the situation we're looking at. This is a highly innovative economy, but the hard work of people, the innovative work of people, most of who are from the United States, but many who've come from abroad and integrated in the United States, have a very diverse society and a much enriched society. As a result, that's being taken by people who are not the value creators. And there's a whole ideology out there which is not being criticized by the economics profession. You will not hear Paul Krugman criticizing shareholder value ideology. You'll not hear Joseph Stiglitz criticizing shareholder value ideology. They wouldn't have the first idea how to criticize shareholder value ideology, because the textbooks that they put out in the fashion of a guy named Paul Samuelson, I have articles on this you might have read, argue to teach students that the most unproductive company is the foundation of the most efficient economy. They have no idea of how value is created, and therefore they have no idea about how value is extracted or appropriated or grabbed by some people to whom that value does not belong. So that's why I come back to, what is this relationship between progressive value creation, people who actually had an equitable share of the gains? And I would say when you have that, you'll get innovation. You'll build a company where people will come to work and get rewarded for their work. But shareholders won't lose out, but they won't be the ones who say this is all mine. And basically, you had that post-World War II in a sense, without it being fully articulated. But then the shareholder value revolution, which I witnessed and I saw how it spread in academia and in business, there was these people who said it's all mine, and what I'm talking about, the hedge funds, the insiders, the enablers, the outsiders, they figured out a system to figure out how much they could get out of it, and if they go along with it. And in the process, they funded both parties. They funded, and they get no real critique. Or in the case of Joe Biden, who I don't know if I mentioned last time, when I had this article on profits of prosperity, stock buybacks manipulate the market and leave most Americans worse off in Harvard Business Review in 2014, it got a lot of visibility for my work. He became a fan of the article. So I met with him a couple times in 2015, including in September 2015 when he was thinking of running for president. And this was the big issue for him. And in 2016, before September 2016, before the election, where Trump got elected first time, he wrote an op-ed in the in the Wall Street Journal, which was all about stock buybacks and executive pay, cited my work, and then said the future of the economy depended on it. When he was running for president, he was talking about this stuff all the time. When he became president, he shut up completely. Okay, why? Because he didn't want to crash the stock market. Now, something weird happened. I haven't exactly figured out why it happened, but this is kind of weird. But I have the screenshots to prove what I'm going to say. Is that article in the Wall Street Journal? I mean, you can access it with a subscription going inside the Wall Street Journal, but you can also access it just by Biden short-term apps of the economy if you Google it. That version. When I went to look at it after he got elected in 2021 or 2022 maybe, in any case, he hadn't been talking about buybacks, and I was talking to a journalist, and I said, Biden used to talk about it, he's not anymore. I said, go look at this article. I went and looked at the article, and it originally said, according to economist William Lazonick, then it gave data from that 2014 article on buybacks and dividends and proportion of net income, and saying that this was a problem because it was, in the 90%, 91% or something like that of net income. When I went back to look at it, at this point, it said, according to blank space, comma, someone had actually hacked my name out of that. I got my name put back because I said I got my good name restored because I knew a journalist there and it got through. I had sent some thing to the op-ed editor. Okay. That didn't just happen by accident. I think someone would rather, in his administration, would have rather that they not have that article out there. And the fact is, it was record buybacks done under Biden. It got worse. It didn't get any better. And so this is the case where he knew about it. And did you hear Harrison Walls talking about this? There's a 1% tax on buybacks, which is actually a Kirsten Sinema tax, because she said that instead of taxing hedge funds at the regular rate rather than capital gains rate in the Inflation Reduction Act, Schumer is on record in a press conference saying he had to agree to put a 1% tax on buybacks instead of something that the hedge funds didn't want. So a little small tax on buybacks, which had originated with Sherrod Brown and Rod Wyden. It was unwise, but in any case, to to get Kirsten Sinema's vote for the Inflation Reduction Act, there was a mention in one of Biden's later State of the Union addresses of putting a 4% tax on buybacks. But I argue that you should have 40% tax and a banner going across the website of every company that buybacks kill the middle class. And the point is,
that would be the day.
Well, yeah. Well, the point is that Schumer. Look at Schumer. He knows that buybacks are toxic. About a lot of them out there, and people like even Josh Hawley, Mark Rubio have written, or at least their people have written about this stuff. There's a lot of people know that, but they don't want to confront the system, and they don't want to crash the stock market.
Yeah, you can't crash the stock market for any. I think that this is what Shiloh was trying to drive at. You basically, if you crash the stock market, you ruin everybody's life.
You ruin all the white collar people's lives.
Yes.
Okay, but if you're
especially people who are like getting ready to buy a home and sell a bunch of stocks.
Absolutely.
I would say you actually would also crash the blue collar people's lives because the value of the company is tied into the stock.
Okay.
If the stock market crashes, the company closes, they get fired. It's like literally
but
like nobody wins.
I
If you
suppose the
crash
blue collar people
stock
just
market.
aren't watching the stock market in the same way.
But they're direct beneficiaries of it.
Okay, but my argument, if you have cancer, do you not try to treat it or do you try to treat it? And the
I
thing
agree.
And okay, so if no one wants to talk about it, the thing is, people are talking about it partly because I'm persistent about it, and the people working with me are persistent about it, and other people, but very few people have done the case studies that show the impact. Okay, so one of the things I mentioned, I'm going to Japan next week, and one of the things I'm talking to the Foreign Correspondents Club of Japan, which is an interesting, I've been there before, but not as a speaker, on the topic is, how the U.S. is losing out in competitiveness and critical technologies. Okay, so people will go and talk about the problems of 5G, Internet of Things, China leadership in this, EVs, Tesla's there, but the Chinese companies are really going to take the lead, and BYD and others are going to assume the lead. CATL is the leader in batteries. In semiconductors, it's not Chinese, it's TSMC and Samsung. Okay, why are those companies world leaders and not the United States? Okay, so in each of those cases, we've done case studies in 5G IoT of Cisco systems, which rather than invest in carrier class equipment for service providers, started doing buybacks and just is grown by just being an enterprise networker, network equipment company. Apple, what Apple did, Apple made Samsung Electronics and TSMC into what they are by giving its microprocessor contracts to them for their smartphones after Intel turned it down in 2007. First it was Samsung, then Samsung became a competitor to TSMC. US has competitiveness in things where now Intel's trying to catch up and having a lot of difficulty doing that, but partly because of the type of investment Apple's made. Apple spent as I said, $736 billion on buybacks over the last 12 years. If they had spent a quarter of that on setting up a state-of-the-art semiconductor company, could have been separate from Apple, U.S. would be a leader in that critical technology. The companies, Apple outsourced its rechargeable batteries to a company that's related to CATL, the Ambrx technology, was related to the leading EV battery charging company. There's no major company in the United States that's a leading company in EV rechargeable batteries, EV batteries. That's because the chemical companies all got financialized in the late 80s and 90s, including the battery companies. One of them, I think, was it Everready, ended up being owned by Ralston Purina, dog food. And companies like Apple and others outsourced to Japan, China, other places, Korea, which have that capability. So there are costs to pay. So then you get the debate going on in DC, of which I'm really not part of, unless people ask my opinion. I'm not a policy wonk in the sense, but then people are complaining about the U.S. lack of competitiveness in these critical technologies. Well, I'm saying, so here's my message: if you're going to complain about that, complain about shareholder value. Complain about how these companies are controlled. And there's also such a thing as a soft landing. and that is you can cut back on the buybacks rather than suspend them all the way. You can recognize, and to some extent, that's being done. So with the CHIPS Act, so when the CHIPS Act was proposed, $52 billion for the semiconductor industry because they'd fallen behind Asia. This was actually under Trump. In June 2020, it was introduced by the Semiconductor Industry Association, pushed in Congress. It came through as part of the Inflation Reduction Act, as the Chips and Science Act. Well, we pointed out that the companies, the 9 companies that the biggest companies that were lobbying for the CHIPS Act, they had done $917 billion in buybacks over the last decade, including Intel and Apple and others. So why were did they need $52 billion from the government? Not that I was opposed to the government supporting the industry, but why did they need it? Now, it turns out that in the Commerce Department, they did, once the CHIPS Act was in place, the Chips and Science Act, they did say that companies that did buybacks, got money under the CHIPS Act, could not do buybacks. But it's not clear how much that's been enforced. They also said that companies, this was a very nice thing they did because Biden went nowhere with his Families Act. They said companies that got money under the CHIPS Acts would have to have daycare centers. So there are things you can do, but in this case, the buybacks part of it, okay, if you can put some limits on that. I've had discussions with many people who said maybe any company that's a government contractor should not be getting taxpayer money and doing buybacks. So you could start there. Okay, but the first thing is to recognize the cost of them. And I think actually to call some of the people out who just are, don't want to recognize the problem. In some cases because they can't, because they just don't understand the work. But certainly Al Gore, or people like Al Gore, should not have been sitting there just without. Apple never gave one single reason why it was doing buybacks. It did. Gave one reason, with two reasons in one phrase that were both lies. Capital return program. That's what they call it. Okay. First, it's not capital. It's just finance going to someone else who's going to make money out of money. But it's not return either, because the only time they ever got money from the stock market was in 1980 when they did their initial public offering. So who are you returning the money to? So we've documented, I gave the case of Icahn. It was $3.2 billion of shares he bought in 2013. He held them till 2016, pushed Apple to do buybacks. He sold them at a $2 billion gain. Not 1 cent went to Apple. All he did was basically get Apple to take money that did not belong to shareholders to manipulate their stock price. He probably wishes he had held the stock longer, because when he was selling, Warren Buffett was using Berkshire Hathaway money to buy it. Warren Buffett's become one of the richest people in the world, actually is somewhat of a progressive value creator, because Berkshire Hathaway, which is his holding company, has about 400,000 employees. And what they do is when they get companies, about 70 companies, they keep the managers in place. They're very stable companies. And they generated a lot of value. And he, for a long time, never paid dividends. At his company, has now only started to do some buybacks, but he had so much money from progressive value creation that coming up to his central office in Omaha, which by the way only has 24 people in it, that he had to figure out what to do with it. So he put $39 billion into Apple stock, which is not something that everybody could do. Okay. But then he started cheerleading buybacks. He actually is on record as saying, I love buybacks. I can increase my stake in Apple from 5 to 7% to 7% without having to lay out a dime, which seemed like a totally morally corrupt statement, but it also says everything, that he doesn't have to do anything. Not 1 cent of that $39 billion went to Apple for any purpose, which went to buy it on the stock market. His gains, realized and unrealized, the last time we looked, which was recently, was about $158 billion for doing nothing. And that's the problem. And that's having huge economic consequences and having huge political consequences. So yeah, there's a cancer out there, or an addiction out there, if you want to use the banner thing. And if, okay, you cannot deal with it, or you can deal with it.
I mean,
And
I like the vision of approaching this from the soft landing perspective because the crisis didn't spool out overnight when shareholder value ideology appeared in the mid 80s in the Harvard Business School. It was something that cumulatively over time came to overtake the market to a degree that there's no other option available to people.
yeah,
And so it seems like it makes sense that the alternative would be to say, okay, hey, things have gotten to be way too intense. This is not a good direction that we're going in. And because of the fact that this is such a bad direction, we should start very slowly, gradually peeling back these layers in order to get to a place that's a stable equilibrium, as opposed to saying overnight, crash it, let it burn, we'll figure it out when everything comes back up together. And so I think that I this is a strangely optimistic note to end on.
well, no, well, it's optimistic in concept, but not in reality, because so I've been working. Okay, I've been working on this issue for the buyback stuff. I would say 25 years or so, but it's not all I do. I mean, I've done a book coming out on what's happened to African American employment and lots of other things, but because it's the bigger picture that I'm interested in. But it's something that became such a cancer on the system that I said, I got to talk about this, and I have to document what's happening. So it hasn't happened. As I mentioned, in 2014, an editor of Harvard Business Review had approached me, not really knowing much about my work, a couple of years earlier, and said, "We want to talk about the future of R&D in the United States." And I said, "Well, here's the angle that I would take on it." And this article ended up appearing. And to their credit, Harvard Business Review left my subtitle in there: "Stock buybacks manipulate the market and leave most Americans worse off." Got a lot of visibility. Even legislation has happened because of that. Okay, but and even the person who was vice president, who became president, when he was vice president, was talking about that. I have an article on the website Institute for New Economic Thinking called "Where Did You Go, Vice President Joe," where I rewrote his 2022 State of the Union address to include buybacks in it, which was not mentioned anywhere. Okay, but the fact is that we're not headed toward a soft landing at all. It's getting worse. It's accelerated, and the rich are making more money and making even more money, and it's always a problem with the political system. But now we can see, it's just right in our faces that everything is going to be done. I mean, I was asked to write an op-ed by someone on Trump's economics policies. What policies? I mean, I said, just watch what's going on, and we know what's going to happen. The rich are just going to get richer, but it's not simply because Trump is reversing everything that was done under Biden or back under Obama. It's because they didn't do anything about this. They allowed it to get worse. And I would say Biden tried to do things, that might, I mean, he was silent about it, but he had some people working in his administration buried away in there, or even someone like Gensler at the SEC that had some worry about it, but they really couldn't do enough to kind of stop that jet from, or that rocket ship of whatever the metaphor is, of just continuing to go off into space, and it's not coming down yet. It hasn't reached the apex yet at all.
Well, luckily the whole of the Trump administration seems obsessed with mimetic victories, and so if you can get this to be a sufficiently popular platform on social media and among the public, I think that there actually
to that end, I was going to say, when we were traveling over break, we had just recorded this conversation, and I was trying on some of these ideas on different people, and it seemed like most people already understood this to be the case. Like, it wasn't a very shocking revelation to most people that shareholder ideology had possessed the corporate landscape.
I think they didn't have a term for it. I think that they didn't realize that it was an ideological shift. Would you agree with that?
Yeah, I think a lot of us grew up under this for the most part, at least people.
Yeah, well, okay. So that I think that's an important point. That, I mean, I saw the shift take place.
Right.
So that, and I was already critical of of this financialization stuff at a time when I knew far less about it than I know now. And so I saw it happening, and I saw it happening at Harvard Business School, which is most of the professors did not believe the stuff in that stuff. And I even now, they're obviously, like I am, much older. I meet some of them, and they said, "What happened?" I said, "Well, I was actually there as I've been a professor in the Harvard Economics Department, untenured professor. I then went on to Columbia, but in between, I was at Harvard Business School. So I was there as a researcher. I was able to kind of learn what was going on there without having to be. I wasn't making decisions about who to hire." I said, "You were making decisions back there about who to hire, what was going to dominate here." And one of them told me that the president of Harvard, a guy named Derek Bach, and the dean of Harvard Business School, a guy named John MacArthur, they went after this guy, Michael Jensen, who was kind of a ultra-conservative Chicago economist from the University of Rochester, which was even further right-wing than Chicago in economics. And they wanted to get him to come to Harvard because that's where the money was, the deals on Wall Street. They wanted this message out there because for them, that was going to bring in money. And it just shows you the corruptness at that level. And I knew Bach to some extent, MacArthur less, but it fit with what I knew about them. So you get people at all different levels kind of going with the flow and even trying to take advantage of a system. And then, basically creating the bully pulpit for people who are very smart people to make arguments that fit what other people want to hear. And so they know about it, but they don't know how it works. I can guarantee you that. I mean, on stuff I talked about, a lot of stuff about that, people have not we figured out how some of that stuff worked, or stuff I said that my colleague and friend Jiang Sup figured out about the proxy voting system. There are some people who know that story from the inside because they use the system. But I haven't seen a critique of that system as part of what's creating, inequality. So if people are going to talk about inequality, don't say that, as Sanders says, there's all these billionaires out there and they're rigging the system. That's obvious. Say, how are they becoming billionaires? And what can we do to tamp that down? And to what extent is the economic, Sanders will say, and it's the same phrase, he says it over and over again, there's all these billionaires controlling this much, there's 60% of American households living paycheck to paycheck. Okay, what is the relationship between those two? We're never told that. And we're never told how, that's what I'm talking about. And by the way, the paycheck to paycheck thing is an interesting thing, because I said, where did that figure come from? And it's, like any statistic, it's not as easy as it sounds, because the surveys that have been done show that a lot of the people who are living paycheck to paycheck, it's not money spent on necessities. So it's people who have often $150,000, $200,000, but they've just gotten into a lifestyle where they're living paycheck to paycheck. That's not the majority of them. Actually, Bank of America has the best survey I've seen, which puts it for people $50,000 or less as being about 35% or 40% are living paycheck to paycheck.
There's a really good fiction book about this. Tom Wolfe, I think in the 80s, wrote a book called Bonfire of the Vanities.
Oh, of course, yeah. No, Bonfire of the Vanities, that caught on because of, the Oliver Stone, Gordon Gekko thing, greed is good, and all that, the excess that people saw it happening there. And here's the irony of that is that when did people get thrown in jail? It was Michael Milken, a guy named Martin Siegel, Ivan Boesky, by whom? Rudy Giuliani. He made his career throwing these people in jail, of all the ironies in the way, yeah.
How the stars have turned.
He's the hero of the story back then, and that was, and that was turned out, obviously, for him to be totally opportunistic. He was, the DA who could go after these people, and he did, and but once his bread was buttered so in another place, he went in that direction. Yeah, so it's a pretty sordid story, where however you look at it.
I mean, I think I've gotten a better handle on it than I did when we sat down. I mean, I think that we kind of told you a little bit before we started that this is a topic that we don't know a ton about. And so whenever we start investigating some field that is outside of our wheelhouse, there's this process by which we're just taking the ideas and sticking them into a cohesive story. And so I really appreciate that you take the time to come and explain what are basics, like what is a proxy fight? What is the difference between the hedge fund and the private equity? And what are the different roles that they're playing? How did they come to be established? How have we gotten here? Like, these are really valuable things for us to find out. And I think that they're valuable for the listeners to get. And I love how your brain works, where everything is that it seems like you just like open up this drawer and you're like, all right, this is what I got on this.
And just for when you talk, I think the kind of people, I mean, a direction is, which is something you had mentioned, is this what's called comparative political economy direction. That there's a lot of people do comparative political economy, and some of them have some of the story that and those are the people who are more likely to have interaction with. Some of them don't. It's all states and markets, and there's not much in the way of corporations. So there's some people who actually, but if they get enough knowledge about another system, they can start on. So one, again, this was catching up on certain things as I'm going. I used to be in Japan a lot. Now I'm going there for a couple of weeks. So there's a woman named Ulrika Schade, Schaede, who's at University of California, San Diego. And I just read a book. I've known her a long time, but just a very recent book called Japan Reemerges, where she shows a totally different story for Japan. So Japan went a little crazy with stock markets and land markets in the 1980s, the bubble, and then it burst, and then they've had what's seen as being the lost decades. And back then, when Japan emerged on the scene, you would see like big billboards, Sony, Hitachi, Toshiba, Panasonic. You didn't even have to know what products they were producing. That's not the case anymore. Okay, but what she's shown is that Japan, because there was a commitment to keeping people employed, and there was a lifetime employment system, as you had in the United States, but there was a commitment to this, that companies had to figure out how to refocus and how to make use of the capabilities that they had. And because the capabilities actually were much deeper in the corporate sector than in the United States, because the advantage of Japan in competing with the United States is they had integrated skills on the shop floor with the engineers. So they and that's why actually, ironically, Japan's a leader in robotics, because the workers whose motions they were imitating didn't have to worry about getting fired. And there was a cooperation around how to actually get rid of this work that could be automated, and Japan is a leader in that. But what that meant was that they slowly tried to move in the direction of doing more sophisticated, I would say higher evaluated, more complicated products. And it took time, but they are doing very well, but we just don't see the products as much. They're the components inside things that we do. They're chemicals, they're precision engineering, they're batteries, there's all kinds of other things.
Oh, that's really fascinating.
So that I think that that message, and this is the message I think generally, you're not going to be able to be an advanced economy if you don't have a lot of capability. And part of the problem actually for the United States is that, and this is going to be a big problem with relations with China, is so much of the capability the United States has is our benefit of having, not just from China, but from India and in particular Korea. But a lot of the Koreans don't come here as much anymore. The Japanese, if they came, they always went back. But the Chinese now are persona non grata as a group, actually, in the United States now, this is going to be a huge problem for the United States because a lot of the Chinese people, scientists, engineers, are going to go back to China, and they're investing in those capabilities there. Many have already, but this is a globalized labor force, and so I'm not against at all the global movement of people, but what I would argue is that you need to do is make sure that when you have a global movement of people to the United States, that the profits of those companies, where of their professional workers, about 45% are Asian American, identify as Asian American, that you have to use those profits for everybody else, and that is mainly blacks and Hispanics. And so that's actually the part of the problem here, that the money that was being made, and there is look forward to my next book, which is hopefully to come out this year because I just have to write the conclusion. But that in the 1980s, when there was some upward mobility, a potential for upward mobility of African Americans, it's not that Asians took the job away, but they changed the immigration system. But it's that because of that, it was an excuse for the government to stop investing in upgrading the capabilities of African Americans and ensuring upward mobility. And when the jobs disappeared, as William Julius Wilson wrote about, and there was downward mobility for blacks, that was because there had been some upward mobility. So that's really a big part of the story, is how you ensure this thing that all the progressive politicians say they want, is upward socioeconomic mobility. Almost everybody says they want that.
And you're like, how do you actually make that? Yeah. I mean, I think that this is why we're interested in these conversations. But I think that we have to put a pin in it for this time. When your book comes out, ping us and we'll take a look at it, and we'll pick up because this comparative political economy and the idea of like what functionally you can do to improve everybody's lot is really fascinating. And I always enjoy talking to you. Our listeners really enjoy listening to you. And so thank you so much.
Good. No, I'm glad I did. Okay, great.
Excellent. All right. Well, have a good rest of your day. We'll see you again.
Yeah. Same to you.
Bye, everybody.